So the TVIX, the SVIX, I've done a couple TVIX episodes. Everybody's talking about buy the VIX, buy the VIX, because it looks like volatility is going to blow up, and it is blowing up. And the TVIX is really cool because it's a 2x. And for trading, for day trading, for like a 2 hour volatility kind of trade, the TVIX is cool because it's levered. But I want to show you what happens as you go to like 2 days, 2 weeks, 2 months, 2 years, with all of these levered futures, ETFs, and ETNs. So here's the whole timeline of the TVIX, and I'm just going to drag it and show you what it does. Watch this. It crashes, and it keeps bouncing up with the volatility, but it keeps decaying to zero. And I'll explain why that happens. Look at it. It always just keeps decaying to zero, decaying to zero. Look at the numbers over here. And we're at whatever it is, 200 now, right? But look where it started. And this is the TVIX. What is this number? $5 gazillion? What in the world? I mean, it's like exponentially decaying to zero. But let's throw the VIX on top of here. And let's take a look at what it does. Okay, so here's the VIX. It's the red line, and it's pinned to the TVIX here. And as we pin it to the side, you can see that. Oh wait, is it tracking it? Yeah, okay. So you can see that the TVIX keeps bouncing higher than the VIX, but long term it keeps just dropping below. And every time the VIX crashes, the TVIX will crash with it, and you just keep losing and losing and losing long term. And the reason this happens is because it's levered, and there's a negative carry. So there's compounding math because this is futures contracts, and each time they do a new futures contract, it resets. So they have to sell the current contract and they have to buy the next one at a higher price if it's going up, and that's contango when you go from a lower price to a higher price. And so you lose percentages every time you have to reset to a new futures contract that's going higher, and then every day it does compounding and you lose percentages on the compounding. So what happens is you go down when it goes down, but your upside is capped. And mathematically, it just always decays to zero, just because of those percentages. Like the up and the down constantly just pull it down, pull it down, pull it down. So the TVIX, for a 2 hour day like trade over one day is fine, but holding it overnight or over a month or something, you start losing percentages. So you can see here, though, if you wanted to short volatility, the TVIX would be a really great way to short volatility, because then those percentages would be helping you short it because you're getting the compounding and the negative carry and the futures rollovers. All those negative percentages are helping you when you short it. And then let's check out something else amazing is the SVXY, which is an inverse VIX. And it's similar, but it goes the opposite direction. So it'll build up, as volatility decreases, it builds up, and then it crashes. And when it crashes, it never recovers. You can see it flatline here. And that's because of the compounding and the futures contract negative carry and the contango. So you can see, it's moving, it builds up, but then it crashes, right? And when it crashes, it doesn't recover. You get the downside with these kind of ETNs, but the upside is capped. So, and this is not investment advice, but I only short these things. I don't go long on them because you just mathematically lose percentages on them unless you want to day trade. But I usually like to hold things more than a day, And even when you're day trading, the volatility is still working against you, which is kind of ironic when you're actually trading a volatility index and the volatility is working against you. But you can see that it crashes and doesn't recover. Crashes, doesn't recover. But when you zoom in, you get all the action, and it does build up from the point where it started, but each crash doesn't recover. So, like right now, the volatility could really spike right now if we get a big drop in the market. And I just shorted this thing. It's like a 2-month short, and I did a put contract, and I'll put option. I'll show you exactly how I did the option and how that works. And basically, it's really hard for it to go up against the short, and so I can hold it for 2 months, and it probably won't go up, even if volatility does the exact opposite of what I think. It'll stay kind of flat, and then if and when it does, volatility does spike and this thing goes down, it can go down by like 50% in like 2 days, and it will never come back to where it was here. Like it'll just get down there and it'll stay down. So it's a really easy thing to short it, and it's easy to short it with a long dated put option. And this is the SVXY, the inverse, and that is what's up. That is the trick for shorting any of these ETFs or ETNs that are built out of rolling futures contracts, is you only short them. And if you want to go long, because I want to go long volatility right now, I think volatility is going to pop, and it already started to. And I bought these this morning, and yeah, and I got like 2-month puts, and you can short the inverse ETF like this, and that's how you go long. So I'm long volatility, but I'm shorting the short ETF, and I'll go over and show you. So here is, you can see the pro shares. This is the short VIX. So this is an inverse fund. It's a short VIX, and it's built on futures, which most of these are. So you get that negative carry, you get that future contract rollover contango effect when it's going up. You don't get the ups as good. And every day when it resets and compounds, the compounding math works against you. You lose percentages in the volatility. So mathematically, this thing decays to zero constantly. And basically, it's just going to keep decaying to zero until they delist it. It'll be worth pennies at some point, and they'll just delist it, and they'll start a new one or something. And you see these things get delisted every few years or something like that, and there's a new one that starts at some high price. But that's how these future contract rolling derivative, kind of ETNs and ETFs work. Is they're structured mathematical products that decay to zero. And here's how we do. So this is a lesson on how to, I guess, get a put, and also how to short an inverse ETN. And we're going to buy a put. So this is a put option. Okay, so I'm on E-Trade here. A couple other tricks for me, like I think we're in a bear market for like a couple of years here on the backside of a bubble. And I think that we're in a credit contraction down cycle right now for about another month. So this is highly, highly risky territory where I don't trust something like Webull or Robinhood or I mean, even like TD Ameritrade and stuff, I checked out all their balance sheets, and their balance sheets are sketchy. And so I read all the balance sheets of the different trading platforms, and what I found was that E-Trade had the best balance sheet of any trading platform, and it has a long, stable, kind of history, and it's like Robinhood has been like blipping up when the volume is super high. Like it's a new platform, so there's a little bit of instability there. But there's a lot of counterparty risk with having your account with, especially if it's a lot of money. This is my retirement account that I'm showing you right here, and so you can lose your money. Like if you have contracts through whatever platform, say Webull, and say hypothetically they went out of business, like they technically own your contracts and they owe them to you, but then they go out of business and they probably swapped them with some bank. And I mean, the legality of who actually owns the thing, and there's probably lawsuits and who knows, but it's really bad if your broker goes out of business. And in a major credit contraction cycle, businesses are at risk of going out of business, and brokerages are capable of going out of business here, especially the newer ones, like the new phone apps that there's a bunch of them competing with each other and they all have like high debt and they're new companies with debt and they can get in trouble. So E-Trade has a super plus balance sheet, like tons of cash, and they also got bought by one of the primary dealer banks. I can't remember. It was Morgan Stanley, right? Yeah, Morgan Stanley bought E-Trade, and that is one of the safest primary dealer banks. It's known for being super non-risky and completely backed by the Fed. So, just looking at all of the trading platforms, I think that E-Trade is the least counterparty risk, the least likely to go out of business, and that's why I chose them. I certainly did not choose them for their interface here. They have a user interface from like 1985. Um, and they also took forever to transfer this account. I was trying to get my money over here to, to trade a little bit on this bull market, not get crazy. Like this account is mostly cash right now because it's a super dangerous market. And I'm just looking at treasuries and cash and gold and some safe kind of things right now. Um, but I just started going long volatility here and getting a couple shorts inside of my retirement account. And another point that most people don't realize is that you can have, like, if you have a 401k, you can you can roll your 401k over to like an E-Trade IRA account, and then that's a retirement account that's held at E-Trade, and when you make trades, you don't have to pay taxes on those trades because it's inside of your retirement account. So you can do day trading inside of a retirement account and pay no taxes on it at all, which is really cool. So I do my day trading inside of my retirement account, and I do like longer term kind of investment stuff outside, or especially, well, I was looking at real estate outside of the retirement account, but I couldn't find anything this year. I went all over the place, all over Asia and all over the place. Um, all over America, looking in Florida and stuff. And I just couldn't find any value on real estate right now. So um, let's buy a let's short this inverse thing here. So buy open, right? And I'll uh, I'll explain the put buying screen here and what an option is, I suppose. So basically, an option is you're buying insurance, and when you buy a put, basically say that the whatever this thing, the SVXY, the short VIX, say this is a car and you're buying insurance for the car to crash. So like if this stock goes down, if the car crashes, you get paid the insurance policy. And how it works is there's the trading price of the thing here. And so it's trading at whatever 31.50 here or close to it, 31.88. And so this is at the money. This is what it's trading at right now. And this is the price to buy insurance on this share price. And so when you buy insurance, you're buying insurance for 100 shares. So basically, and we'll just hit market to look at the numbers. So here you can see that it's 54 cents, but it ends up being times 100, and the market value would be in between like 49. It's calculating, that seems low. It's calculating 49 for the market value. Oh, because that was the last trade, but this one would probably trade at 52. But you can see that the price is 54 cents, but the actual price is should be like $54. And if you do limit, like it says 50 and 54, so you could just put in 52, and so that's one share. and that gives you control of 100 shares of this short VIX. And you have control where if it goes up or sideways, you're going to lose this insurance money here. It has to go down for you to get paid, and it needs to go down right now. The longer you wait, the less time that's on the policy. So see, here's how the amount of time that you have on your policy. So, well, I mean, hypothetically, on your option. But so for me, I think all the volatility is probably going to happen before June, like around June 1st, maybe ish. I think that the kind of the downward movement and the craziness will be over the next few weeks ish. And so for that, if I think it's going to be the beginning of June, it's a good idea to buy an option that goes out twice the time length that you want. So say like this one, the weekly ones have less people trading on them, and the monthly ones that don't have the W have more people trading, so they're easier to trade. It's usually easier to find a good price on these longer contracts rather than the weeklies. So say June here, 19. That's roughly double the length of time that I think it's going to take to get down, and you want to get at least double the time length that your target is, because the first half of time you don't lose that much money on your option, and the second half you start losing a ton of this buy-in price. And so $50 maybe doesn't sound like a lot, but if you put 100, uh, if you do 100 contracts, that's really 10,000 shares. And so now this is the insurance price, but you have you're controlling 10,000 shares of this. So add, 4 zeros to this, and that's how many shares you're controlling. And say it drops in half, that's the spread that you would get to keep. It's a big number. If it drops like in half, it's a huge number, and this thing is completely capable of dropping in half and not bouncing back up. So it's a really interesting thing to short. And since it's the inverse, I'm actually going long volatility, but I'm getting to short this product that is capped. It has a negative carry, so the negative carry helps you when you short it. And you can actually go long volatility by shorting the inverse, and you can get the negative carry. And it is important with an option that it does go down. So, like for this type of thing, like this SVXY, it tends to just barely fight its way up, and then it drops. So you want a time length that will get that drop, like however long that takes. And you want it to happen right now, but maybe June isn't the best length. Maybe you think the volatility is going to happen in the next 2 months. Maybe you want to go out to whatever, September or something. And that's a longer contract. And then you'll see the price is still pretty good, actually. Oh, okay, here we go. Yeah. Oh, wow, look at the price swings out there. Wow. Huh, this is really cool. Oh, so you get a really good deal going out of the money here if it goes in half. Wow. Okay, so, and this is completely pointless for me on the timeline that I see volatility happening to go out this time length. But you can see here the price of insurance varies greatly. So, like if you are going out of the money here, it's at 32, right? So this is less than half, and the odds that it gets down to that price is really low, and the odds that it actually breaks that price to where you could get paid on the insurance policy is even lower. So it's really cheap to get insurance on that price. And so there's a really, really high probability that you lose all of your money on this, but you don't have to cash in the insurance policy. So if you bought a contract out to September, and it goes from 35 to 25, say, in the next 3 weeks, you could just sell this contract to someone else, and you'd get most all of your insurance money that you paid back when you sell it to the other person, plus the spread on this kind of price difference, which could be pretty huge. Because look at this. Like if it got to 25, this one would be, $5 to insure. So that's kind of the trick for trading options is you don't actually want to wait until expiration. You don't actually want to exercise the thing and claim the insurance money. You just want to trade the contract to somebody else. And you want it to go down right now, and you want to trade it to someone else so that you get most of your insurance money back plus the difference of 100 shares. So that's how you trade options. That's how you short an inverse. And then the limit price here is on this, whatever. So, I mean, let's look at this thing. So we want to go, let's go to the $20 one, because it could very easily get to 20. And this is all the way out to September, which is nutty, but just the price difference here, you can see how huge of a price difference it is for insurance over this long time period. So that's a spread that you can win on. So you can buy the insurance for cheap here, and then if it gets down to your price, you're actually selling the insurance policy for this price plus the difference in the stock price. So that's how you trade longer term options without selling them. Like I could buy it all the way out to September, and I could just trade it to someone else in 3 weeks, and I could make the difference on the insurance price plus the difference on the stock price. For 100, and it says 100T, this is 100 times this price is the actual price of the stock that you are controlling. So if this goes from 32 to 15, oh, it's an inverse, so you have to, yeah, you're betting on it to go down because volatility would be going up, and so this inverse volatility fund would be going down to 15. And when it goes down and you trade the contract to someone else, you get the difference here. So that would be whatever, $1,500, right? Plus the difference of the insurance price, which would be whatever it is. I don't know, maybe. I mean, you have to lose money on how much time passed, but then you get to trade the difference of the insurance price. So that is what's up. And yeah, good for the day. Usually you just trade it during the day, and then usually you want to do a limit. If you do like market price, then it won't always trade at the worst price. It'll usually trade on the worst side of the halfway point. Like most trades happen at the halfway point between here, and you can just specify the halfway point if you want it to trade right now. Usually it'll trade at the halfway point. You just put 50 here, and you can see the last trade was 51, so that was above the halfway point. And say if it's like falling, if the stock's like falling right now, and you want to trade it right now and get in it at whatever price, you can put market, and these prices will be changing, and then it might not be a good price, but it might be a good price if you put a limit price in and it takes you a couple seconds to get the thing set, and then you have to go check your trade screen and it doesn't close, and then you have to close it and come back and try again. Like all the time that you lose if you're day trading doing that, you can not make the trade. So sometimes the market is good if it's like on a rip down or up, and you just want to get in. Make sure you get in. You can put market, and you'll definitely get the trade, but not as much control over the price. And another thing with options is if you're trading options on something that is less popular, like if it's a spider fund, there will just be tons and tons of people trading these things, and it's kind of like Craigslist or something. Like you're selling some used kind of thing, like when you're selling the options contract back. But if you're on a big like spider fund, there's like a million people trading it, and you can see how many people have open orders here. I mean, it's not a million, it's 100 or 50 or 20 or something. And so like one of these people that's here has to buy your thing. It's not like an automated like robot that does it. This is a person buying your thing from you. Well, I mean, some of them actually are controlled by robots, but it's still somebody's fund, and it doesn't just automatically like like just trade with the broker or something. It's actually another person buying it from you. And so like if you go into like a small stock that just doesn't have a lot of people trading options, sometimes you can get a really good price buying it because you just see somebody just trying to get rid of it. They get desperate or something, and you can see like it'll be like $3, $1, and then sometimes it'll just be like 10 cents for an option. Like, what? And you can just like try to get it real fast, and they'll sell it to you for cheap. Like it's like a yard sale or something. Then you can just turn exactly like right back around and just sell it at a normal price. So you can just trade these things kind of weird, buying cheap stuff at a yard sale and then turning around and selling it. If you're on a really small stock, you can kind of do that. But the opposite is a problem too, because if you're on a smaller stock and you buy something at a normal price, and then say some time passes and you want to get rid of the thing, and there's nobody buying it, then you just like, how do I sell this? You don't even know what price to sell it at, and you just like list it on here and nobody's there, and you just, I don't know, keep lowering the price until somebody buys it or something. So you can get stuck with options contracts that you don't want on smaller stocks. So it's just a lot easier to trade options on big ETFs like the XLK, or or a super popular stock like Tesla or something. It's really easy to trade options on big popular stocks and ETFs. And this one has enough trading, but it's not going to have the kind of volume of like the TVIX or something like that. So that's something to keep in mind also when you're doing options contracts. And then there's a bunch of complicated combination strategies here. I guess I could just click on like a collar or something. And so like when you do a collar, you're kind of like doing calls and puts at the same time, where your risks are offsetting each other. Like you're buying like insurance at the edges of your risk ranges. So it can get pretty complicated. You can buy combinations of contracts on the same thing, and like net you're going short maybe or long, but you have like insurance against it going like against you. And so kind of limit your risk a little bit more. But this is just simple buying a put. So you're shorting it if you're buying a put, and then the person that's selling the put is selling you insurance, and that's a completely different strategy for selling puts or calls. But this is buying a put. This is how you short something. Just straight short it with an option. And yeah, so I guess I covered most of the time length ideas, and like it does need to get down, because you bought this policy, it costs money for the policy, and if it doesn't go down, you lose all your money. So say you had like $1,000 in an account or something, and you buy $1,000 of put options. If it just stays flat over the time period, like you lose all $1,000. Like it's kind of like an all-in bet. But when it does go down, you're controlling 100 shares, so you get like a multiplier on the movement down. So you could get like maybe 5 or 10x your money if it really goes down fast, and you can lose all your money if it doesn't. And then if it goes the wrong direction, then it's really hard to get back to where you started and down. So that's why if you bought out of the money here and it went the wrong direction, then you would be way out of the money and this thing would be super worthless. But if you buy out of the money now and it does go down like around that price or past it, then you have a super, super valuable option that's near the money, that's easy to trade. So like the price targets and the time lengths are very important, and that makes it so hard, because timing, and that's the hardest stuff to do in your trading, is the exact time when it's going to go down, and like get it right at the peak. And it's not the same as just trading something and kind of selling it when it's a little bit up whenever over the next week or year or something. It's like this thing is a contract for like 1 month, and it has to go down right now. And if it doesn't, you start running out of time. So I guess that's pretty good for this one. Please hit the subscribe button that's over here somewhere, the like button. And I think that's all I wanted to cover for the VIX, for the volatility. Other than just talking about volatility, I guess, in general, as an indicator, like the entire stock market right now is at a high volatility level already, which just means the whole stock market is dangerous, and we are in the middle of a credit contraction cycle, which is a high volatility cycle. and the volatility calmed down in the middle of the cycle, and it should kick back up before the end of the cycle. And that's what usually happens in a credit contraction cycle. You get the volatility on the first drawdown, and then you get the lower volatility in the middle, and then the second move down, you get more volatility. And so switching out into the next phase, which should be whenever, kind of in the middle of next month, I think. Should be like a month or a month and a half when we switch into the next market conditions. And then it's no longer a credit contraction cycle. Then it's an expansion growth phase where money becomes available to companies again. And that's when the companies start looking like a bull market and going up. That's when people are going to be really scared to buy anything because it's after the end of a cycle. It's a bunch of volatility and craziness. But like at that point, when it switches, you don't want this thing anymore. This, because the volatility would just decrease over time, and normal stocks would be going up. So that's what I think. Maybe the volatility might peak around the beginning of June, and the cycle might end a little bit later, maybe the middle of June or something. It kind of looks like that right now, and then so you'd get out of this, and then you could trade the end of the cycle, and then go long on the next cycle. Basically, this is a terrible cycle to go long on things, except long volatility and long dollars, and then play around with some shorts. Except for kind of the little bull trap movements, which are scary because you don't know when they're going to turn over if you're long. And the last 2 days just got a big rip down for people that have been buying in over the last couple of weeks. Just got ripped if they were long. So we'll see. We'll see. I'll cover the kind of the time scales and the shape of the cycle and the bounces, and then you get some technical analysis going inside of the cycle, and the technical analysis makes way more sense once it's set up inside of the credit contraction cycle or the expansion growth cycle. You can see like the shape of what the cycle usually does, and then you can see the trends doing it, and then when you draw like a bull pennant, it's like, oh yeah, it makes sense for it to do a bull pennant here because the cycle is making like everything kind of do that or something, or like the M double top thing that we're seeing now on this cycle. It's like, yeah, that's extremely dangerous formation on this cycle because you can get a big downward movement in a credit contraction cycle off of that kind of shape. Whereas like that shape wouldn't really, it would be a fake one if you got it in like an expansion phase. So, okay, that's good enough. Thanks for watching. This is not investment advice, and happy trading.